Good afternoon, everyone. Welcome to Cleantech Conversations, which is an online event series by the National Cleantech Conference and Exhibition. My name is Tiffany Bauer and I am the Program Director for the National Cleantech Conference and Exhibition, which is taking place in Brisbane in March 2021. Today, we are discussing raising capital and securing investment for cleantech innovation in today's market, which is brought to you by our collaboration sponsor, Providence Asset Group. Providence is an innovation-led investment firm financing and managing multiple assets in renewable energy, generation, storage and technology. Established in 2018 by Henry Sun and Alan Yu, Providence's mission is to empower a sustainable planet. Providence is a member of the Responsible Investment Association of Australia, and their strategic investments in clean technology and green infrastructure projects will deliver positive social, environmental and economic impacts. I'm sure you will agree our panellists today are considered to be at the forefront of Australia's technology investment landscape, and I'm pleased to introduce our facilitator, Matthew Muller, who is the Head of Strategy at Providence. Matthew brings 20 years of experience in business strategy, pricing, behavioural economics and marketing across banking and financial services, aviation and social sectors. Previous experience as executive leader at Westpac and CBA, and Matthew was also instrumental in the development of CBA's Carbon Solutions Program and CEO of the Davidson Institute, which is Westpac's financial education advisory. Matthew will be moderating the session today. So without further ado, Matthew, I will hand over to you to introduce our panel.
Thank you very much, Tiffany, and welcome everyone. It's a pleasure to be hosting today's Cleantech Conversations on behalf of the Providence Asset Group. Our subject today is a great one about raising capital and securing investment, and really it's the lifeblood of many businesses of how you go from the idea into commercialization, and whether that's through partnerships with government grants, private equity or institutional commercial lending. It's how we as a technology and an industry push ourselves to the next level. And with that, I've got four wonderful panelists that will actually talk to each of those areas of the business. So we have James Burkett, who's the CEO of the Table Club, which facilitates a lot of private investment within Australia. We have Amy Keane, the director at Stride Renewables, who has a boutique consultancy services in the renewable area with great government connections and understanding. Warwick Dawson, Director of Knowledge Exchange at the University of New South Wales. When we talk about capital, all capital isn't just dollars, it's also human capital and understanding. And also Stephen Crane, who's the Managing Director of Energy and Natural Resources from Societal Generale. Welcome panel. Just for an overview of everyone on the webinar, what we're going to talk to today is about the changes. Have there been changes in investment during this year? So I think there's going to be a live poll up to get your understanding of, has this impacted your clean tech innovation? And then the second part of this is how best to engage and navigate this environment. And have there been changes? And if so, how do we pivot to ensure that we give the investors what they want? And then lastly, we're actually going to do a case study. So Providence Asset Group, as Tiffany managed, we look at both large scale, so infrastructure funds in renewable energy, but we've also got an early stage venture capital fund, which really looks at clean technologies, emerging technologies. And the case study that we're going to show today is one of our latest ones that we have. And then we're going to just go through the panel to see how exciting of an opportunity that is, and what would we need to do to raise capital or investment from each of the individual groups that we're talking about. So first of all, I'm going to kick it off with Amy. A question over to you. Now, 2020 has been an interesting year. You've got your finger on the pulse of a lot of what both the New South Wales government and federal governments are doing. There's been a lot of changes that have happened with governments and government funding. Have you seen, what are the biggest changes that you've seen for this year? I think you might be on mute.
Always good to unmute on Zoom. Thank you. Hi, everyone. Thanks for having me, Matthew. So I think it's fair to say that the world, and don't press your spacebar button either. I'll try again. So the world has absolutely changed. Obviously, COVID has led that change, and I think that's led to the approach to innovation and funding changing, and the role of the government. So obviously the governments across the world have stepped up immensely, and appropriately so. And I think increasingly we're looking to for co-benefits. So jobs are crucial, and the world is grappling with what future jobs look like. So any area of technology or innovation or funding will require consideration to future jobs, to manufacturing, alongside the policy objectives that will be the nature or interests of the government. So we can't think enough of that. And manufacturing, so certainly where I live in New South Wales, government's very interested in local manufacturing, smart manufacturing, what that future looks like, and how they can create jobs beyond industries that may have fundamentally changed, perhaps forever. And I think we very much feel that the fact we're all on Zoom today is such a step to where we were last year. But that also creates opportunities for new industries. I think community element of it's really important too. People are feeling a lot more personally impacted. So some of those softer things that may not have been considered in the past by governments is taken a lot more seriously. So the community impacts, the social side of things are increasingly important, as we're so much more vulnerable than we were a year ago. So I might leave it at there, Matthew, but I'm happy to comment more from questions and as the panel continues.
Thank you, Amy. I actually just had a question there from the panel. Are we talking international context or Australia? Mainly we're focused on Australia at the moment, but I think with clean technology, just because of the marketplace, we will actually have international ramifications. And that's a beautiful segue over to Stephen as well, because his business obviously is European main based, but they're actually a global banking organization. And for you, Stephen, have you noticed, last time we went through kind of a rocky financial period was way back in the GFC, where funding did really kind of dry up, so to speak. Have you seen the same elements happening in the marketplace this year, or is it business as usual from your perspective?
Well, thank you, Matthew. It certainly isn't business as usual, I must say, but I think, we're sort of heading into serious economic headwinds at the moment. And from a banking perspective, that does mean that our cost of funding has been going up. But that said, I think you need to see that against a time of generally very low, almost historically low interest rates. So the increase in cost is at least largely set off by those low interest rates at the moment. I think in terms of our risk appetite, our appetite to lend, banks are of course cautious, but I haven't really seen a change in that. I think, we have been continuing to lend both in the energy transition area and elsewhere, and that would apply globally. I think what's interesting perhaps is a couple of things. We're getting strong support from our central banks. Our central bank, of course, is in Europe, but I think we're seeing that across the world. So the central banks are very keen to provide whatever support they can to commercial banks like us, to enable us to lend and to try to finance any kind of activity that will help get out of build up the economy in the post-COVID environment. Interestingly, in Europe, the central bank, or the European Union, has instructed central banks to provide additional support to banks to lend, both for the funding of infrastructure and investment in the energy transition. So we actually have a favourable capital allocation towards those particular businesses, which is very new. It's only come into effect, I think, probably yesterday in a number of countries. So that will certainly help the business. I think, and then lastly, I'm speaking from the commercial banking experience particularly. But of course, we're also looking at investors coming in the bond market as well, who provide a lot of support to industry generally. And there is a growing market for green bonds and sustainable bonds. We're still, it's early days, I think, with those in terms of whether they're providing preferential terms for their borrowers. At the moment, to some extent, it's more to attract attention to the business. But I think on the whole, we are starting to see some favourable treatment there as well.
Thank you, Stephen. That's really good news, and hopefully maybe the Australian Central Bank might put some of those same favourable terms in for our lending institutions here as they have in Europe. That would be amazing. As I mentioned earlier before, not all capital is, or investment is, purely in the terms of dollars and cents. And Warwick, from the university's perspective, have you seen changes? Now, naturally, the university have had a couple of setbacks with the movement of people and students, etc. From your perspective, how is that changing how really the research capital or that human capital demand is happening with the market? And, when you look at clean tech and innovation from what the University of New South Wales can deliver and participate in.
So thanks, Matthew, and thanks, everyone. The good news from our perspective is that there's been no slowdown whatsoever. So we were expecting the worst, but hoping for the best in terms of our revenues, but year to date, they're well up on last year, which just goes to show, I think, that Australian industry is recognising the need to continue to innovate now more than ever as a way out of this crisis and to really demonstrate our competitive advantage. So we're also heartened by what we're hearing from Neville Power, Andrew Liveris and others around a renewed emphasis from government on high value, high margin manufacturing. Not just UNSW, most universities will be well placed to take advantage of that. And the critical piece that I think is really exciting is that this situation is accelerating actual implementation of much closer relationships with industry partners. We've known in Australia for many years that our universities are great at knowledge creation. We're in the top 100 in the world on latest rankings, but we haven't been as good at dissemination. And for dissemination, translation, and application, we must partner to maximise the impact for Australia. And not just at UNSW again, but most universities, if not all, are looking at ways that we can actually put into practice much closer relationships with partners. So we're looking at freeing up thousands of square kilometres on our campus in Kensington for exactly that: co-location, co-working, co-creation of new technologies. And this should accelerate the pathway from laboratory to market. In terms of human capital, even pre-COVID, our students were demanding much closer interaction with industry partners throughout the duration of their degrees through things like work integrated learning, industry challenges, industrial training. And so that, I think, again, will only continue to grow in a post-COVID environment. And again, it's mutually beneficial for our partners to have access to that talent while they're studying and put them on the pathway to future recruitment. So, there have been some blessings, some silver linings for the sector. There's plenty of headwinds still to come, make no mistake about that. But in terms of the acceleration of innovation R&D, we look like we're in a good space.
That's good to hear. And James, over to you next. Like, to round it out, when we're looking at all our forms of capital, it's the private equity market. And probably, James, for the people on the webinar, they mightn't know as much about the Table Club. Do you want to give us just a brief explanation about what you do? And then what have you seen? Have some of your private offices or private investors looked at, are they changing their expectations of return, or have they stayed exactly the same? And with the whole environmental ESG, sometimes people go, that's awesome if we're, private wealth, we're happy to put some money into that. However, when, the main vehicle is struggling a bit, that nicer side now is not so important.
Yeah, thanks very much, Matthew, and welcome everyone. So the high level, the Table Club is a network of high nets, trendy term family offices. So rich people who basically have formalised structure to manage their investments, and both core, which could be operational assets, but also positive rent rolls, income, dividends that come off those core assets, and they get deployed. So firstly, it was interesting. I've worked for a number of families over the years, and one of them, a multi-billionaire, said, rule one, don't lose money. Rule two, don't forget rule one. So they do exhibit sort of interesting characteristics, that they're sort of absolute return investors. They're quite opportunistic, and they're quite thematic. So following, say, the thematic theme, they do get big changes and they can move quickly. So they do get the change to renewable energy. They are interested in it, but they've also got in their core and their main investment portfolios, they've got quite high investment hurdles. So, they're really looking for definitely 10% plus type returns. And then if you look at the last probably 12 months, they've taken a lot of money off the table as they felt equity markets were expensive. I would say if you look at the top 200 families, say the rich list, that's about $350 billion as of last year. So the average wealth is very high, 1.7 billion. About 30% of that's been sitting in cash. Now, they don't care they're getting nothing on their cash or next to nothing. It's opportunistic. Now, as it played out, a lot of people, when the COVID started, and I think 23rd of March was sort of a D-Day, happened to be my birthday, because I know I had to cancel my restaurant booking. But a lot of people were either sitting on the sidelines saying equities are too expensive, we don't want to get in, we're happy we're sitting on our cash. Others were very actively in there as sort of opportunistic because they felt that things got absolutely smashed. We'll come back and talk about attitudes to renewables, and I'll talk about their foundations, I guess, further in it. But people have been sitting on a lot of cash and are quite thematic.
So that means, and there's a question here about the observation of the investment appetite in the energy startup ecosystem. I guess, even throwing that open to the panel do you think that's increased now, Stephen? It sounded like in the European central banks and over there, it's definitely an increased appetite, or is that for core infrastructure programs versus the startup that we're looking at the moment?
I should probably clarify that. I'm generally talking from a senior debt perspective, which is not usually going to be accessed by startup companies unless they have strong parents who can provide a guarantee, or if it's in the context of an expansion in a project finance structure. That said, I think there is a lot of support in Europe for the sort of small, medium sector, and there is certainly enthusiasm for the technology sector, and particularly where it's linked to sustainability and infrastructure as well. And we have in Europe the European Investment Bank, and there's a number of European funds around that. And they work very specifically towards providing early stage capital for startups.
I still think it's one of the good questions that came through before, is this whole startup phase is a very interesting element of where you receive money. And I think, James, you were even alluding to that before, is still a strong appetite of the family officer, or are they more, not so much the startup, but the early adoption phase to look at the growth of the business that they're investigating?
Yeah, I'll refer back to, say, the top 200 richest. When you analyse them by age, 93% of them are first or second generation. So they're still very active wealth accumulators. If one of the panelists talked about Australia versus the rest of the world, if you look at the family office sector in, say, the Europe or in the US, the wealth creators are long gone. And so a lot of them are basically trust babies, and they take a far more outsourced approach. Whereas in Australia, we're such a young country and we're such really the high nets are still very wealth accumulating in their strategies. But because they can move quickly with trends, often the guy sitting across the table cuts the check, whereas if anyone's had to deal with a superannuation fund, good luck. It's going to take you years to get through the various levels of gatekeepers. But the families, they can say, I like that, I get it, I want to invest in it. They also want to take leadership roles because they feel this is how they can give back to society, that they're wealthy and that they can make a difference with their wealth. And we'll talk more about impact investing as we go through.
Thanks, James. Amy, from your perspective, have you seen a stronger movement towards that startup phase? Have you seen governments really supporting that? And interesting, we had I think it's Joanna has asked a question about clean tech is often associated with generation, but not also the efficiencies it's playing. So in your overview, is it more about the renewable energy space and infrastructure, or is it actually the other efficiencies that you've noticed from your perspective?
Yeah, I think the first part of your question, is there more interest in innovation? From an energy perspective, which is my world, I think the world has, very much realized that we're in an energy revolution. It's happening right now, driven by the economics. Renewables is the cheapest form of energy, yet our market's still generally powered in Australia by coal. That's quickly ending. Those clunkers are going to leave the market. They need to be replaced. So there's a supply and demand balance. And we need to have the innovation in the market to bring the new technologies to meet some of the technical requirements. How you firm up wind and solar is really important, how you integrate that into the grid, how you maximize energy efficiency, because energy efficiency is the cheapest form of energy you've got. You're much better to use less and use it in a smarter way. So yes, we know that we need the R&D and we need a pipeline to move things, as Warwick said, from the lab into manufacturing. But then in terms of the second part of your question, is it just about renewables? Well, no, absolutely not. As I said, that's only one part of the equation. That's the supply. You've also got to look at the demand, and you need a ecosystem of different technologies in order to provide both the power, but also the market needs innovation from the IT all the way through to the mechanical engineering, and we need smart, clever technologies along that spectrum.
Thanks, Amy. One of the questions that we often receive, and as Providence ourselves, we've received some CPRC grants, which, Warwick, we're both co-participating in this. Do you see that as a really important way for certain industries or projects to really kickstart that first phase of a investment opportunity? And there are some other ones of how do you catalyze private investment. I still think government funding and universities have a really important part to play to really, it's nearly like the proof of concept that we can do. Do you mind commenting on?
Yeah, sure, no problem. So even going back to the National Innovation Science Agenda launched in 2015, that was somewhat of a turning point in terms of the government focusing on what it can do to stimulate this engagement, much needed engagement between the research providers and the end users, typically industry. So we saw a range of schemes introduced there. Some of them will be familiar to the audience, including things like Innovation Connections, Commonwealth and state government. We have tech vouchers, and more recently the CRC projects that you just mentioned, Matt. So these are very welcomed. They de-risk the investment from an industry perspective. It establishes the trust that's needed in terms of a collaboration between the researchers and the industry users. And at UNSW, we've always had that in our DNA, and we're very focused through our engineering school and other faculties on the translation of knowledge into products. So I agree, they're key enablers. We are waiting for Neville Power COVID Commission outcomes. We're excited about the prospects there. Of course, we have ARENA, which has been active for many years and has supported a whole range of technologies, including ones that we're very proud of in terms of solar and emerging in hydrogen. which could be a real game changer. We're very proud of solar, but as we all know, all of the commercialisation was offshore, and we're hopeful with hydrogen that we can create a local R&D, innovation, industry ecosystem and keep those benefits local to really expand our engagement globally.
Yeah, and we're looking forward to the hydrogen too. Now, just on that point, before we go into our case study, just both to Stephen and James, you know, we've talked a bit about some government funding, the proof of concept with the university. Does that make an investment or the risk profile, the lending, more attractive to your specific areas? So to the family offices or private investors, does it increase that attractiveness? And same to Stephen, does that help eliminate some of the risk and provide greater certainty, you know, to a banking organisation?
Well, if you like, I'll start on that one. I think if you take CSIRO as an example, they've got access to a lot of intellectual property. And this is not just renewables, but across, I've noticed there's a few questions around startups and other types of investments that will benefit the economy. Most of our big family offices, unless it's strategic to their business, they've got a particular interest, early stage venture capital, they've worked out it's too easy to make mistakes and therefore it's easier to outsource to professionals. So the venture capital market, I would say 90+% of that, you know, those rich 200 would outsource to VCs. Now you've got specialists in early stage, you know, and then we've got the offshore group. So we've just seen this. So venture capital's been one of our most popular topics over the last 2 years for our old former communication, which were lunches and private rooms for 20 people all over the world. Well, I think this is webinar number 26 for me since the beginning of April, talking to people. So the VC market, for anyone in the audience, they are still a natural place to go to for early stage capital, unless, I think someone was talking about plastics or manufacturing, unless there's a match between families that have operational businesses in that area and they see that by seed funding these, it's going to assist their businesses. So maybe over to you, Stephen.
Okay, well, sorry, I'm not on mute. Yes, thank you. I think, you know, from a debt perspective, we're tending to look at projects at a slightly, sorry, is my video not on? Yeah, it is. From a debt perspective, we're tending to look at funding a project as such, which is probably past a proof of concept stage and past at least some initial proof of commerciality as well. So we'd not be looking so much at sort of CSIRO or arena funding, but the area I've been focusing on, which is hydrogen. Most projects in and of themselves are not competitive with the fossil fuel alternatives they're competing with. And they need to have some form of government support. Now that government support may come in many different forms, but certainly if it comes in the form of a direct investment or a grant in the project itself, undoubtedly that is very helpful because, and firstly, it makes the economics work, or one hopes that it's going to make the economics work. But on the other hand, it also demonstrates, you know, a clear and direct form of support from the government. So I think the answer to that is yes. Just perhaps a slight digression as well, picking up on James's point, is that a number of projects also get support, or startups may get support by having a shareholding from a very much larger company. And there's many cases of this, whether it's a Japanese trading house or a large German industrial company, or it could be a company here. If that's a company that has a strategic reason for an interest in that project, it will undoubtedly have strategic relationships with banks like ourselves, and that also will give a significant help in terms of getting additional support.
Thanks, Steve. And I think that actually goes a lot to a point that Chen, you just wrote there. The business case is good enough, and that's sometimes where that seed funding, whether it is from government, as you just quite rightly connected, makes the economics work so that you can actually see that pipeline increase, so that the business cases then can go to that next phase for investments to work. Now, there was a bit of talk about hydrogen, and I think to put this all into practice, just looking at the time, we're halfway through, we've got a video that's about to be played. So this is an exciting collaboration. So Providence, in our early stage venture capital, has partnered with H2 Store and the University of New South Wales, and we're looking at a hydrogen battery itself. So we're going to play this video, and then what we're going to do is kind of whip around the room to go, well, what are the key factors that you would, first, do you like it, yes or no? And then why would you back it? Or what are the things that you would want to see to answer your investment questions? Because this might be the same issues that other companies on the line are facing as well. So Tiffany, if you're able to play the video, that would be great.
The sun. It wakes us, warms and brightens our day. It powers not just us, but the planet. Clean, efficient, free. So why waste it? Let's harness it and realise its potential. Introducing Lavo, the world's first residential hydrogen battery. Australian-owned, designed and manufactured, we harness sunshine to power the nation. Lavo integrates with existing solar panels, optimising energy anywhere, anytime, with capabilities to use for now, store for later, or sell back to the grid. Engineered by H2 Store and the University of New South Wales, the hydrogen energy storage system is pioneering technology, using a patented metal alloy to safely secure and store hydrogen, the world's most abundant, accessible and cleanest source of energy. Using the sun to create hydrogen from water, our fuel cell converts hydrogen into electricity. Capable of storing 60 kilowatt hours, Lavo will power the average Australian household from sunset to sunrise, today and tomorrow. Our unique hydrogen hydride is made of recyclable materials, outlasting and outperforming traditional lithium battery technology. A cleaner way to store the sun, with infinite potential to power homes, businesses, communities, and even countries. Renewable, reliable, sustainable. Lavo. The power is in your.
Well, thank you for that, Tiffany. And while the panelists get their responses back, obviously Warwick and University of New South Wales was an integral partner in this. And you did mention before about, the path to commercialization. So I just wanted to hand it over to you, Warwick, just for a bit of an intro. I mean, why did University of New South Wales back this, not only with their research centre and everything, but they've also put in some commercial funds as well. Can you explain why the university did such a thing?
Sure. So not specifically for this one necessarily, but more generally, we're quite agnostic. We've got 2,500 researchers researching in all different things, and we will support them in their endeavours to take new technologies to market. But clearly here, we have a great opportunity in the hydrogen space to create something of significant value for our country and the globe. And so that always grabs our attention and, if you like, gets a higher priority. We go through the usual steps that we do with new inventions. We secure the IP, we make sure that we have that locked away with a competitive advantage. And then we look for partners to work with, and H2 Store Providence have been working with us now for a couple of years. You guys won the CRCP along the way to fund the ongoing development of this technology and to start considering the pathways to market. So, we've got a great technology, but we also need the people who can drive the opportunity take it forward, and we need to ensure that we're delivering something that the market needs and that customers will buy. So there's all those aspects involved in, you know, the success factors or ingredients of a successful investment. So it certainly ticks all those boxes for us.
Thank you. And I guess for us, this is a bit like a Shark Tank kind of thing, is like, so would you invest in us? And if so, why? I'll go, Amy, to you first.
Thanks, Heath. I guess giving the government perspective is what I think you wanted me to do. And the government for seed funding is very important, as was previously said, to then leverage debt and equity. The consumer perspective is really important. Let's say the public good. And that speaks for itself anyway. I understand when you can provide firm power at the economics that's cheaper than the grid, consumers want that. But that alone isn't enough. You also have to have the safety, and that I obviously know about the Lavo technology. I understand that's addressed through the solid state metal alloy hydrogen technology that isn't combustible. So that's really important. But you need the standards to prove that. So consumers want their protection with any new product, and that needs to be backed by standards, either at international or certainly in Australia's case, Australian level. I think we're also looking for the innovative side of things. We've talked a lot about future jobs, future manufacturing, new technology to meet future energy needs. So that would be considered, and that innovation box looks like it's well and truly ticked. And then the jobs that are created, both direct and indirect jobs. And there's certainly not all technologies have the jobs multiplier that is not equal, but that jobs multiplier is really important. Again, post-COVID, trying to restart the economy, looking for flow-on jobs, and that's where the manufacturing really comes into play, as well as the jobs like the installers, for example. Trades jobs is important, and also regional Australia. What impact it has on regional Australia is a priority right now for obvious reasons.
Thank you. And we've just received another question as well, is that on the supply and demand, how can we move towards a demand for renewable? And I think part of this product is part of the suite of that, is if we can also create products that people want to use, such as their own home energy storage, other things like EVs, etc., then we can really push that supply side as well. Now, over to you, James, from private family offices and early stage investors. Is this something that's ticking the boxes for them at present, or are there still a few more hurdles that they would want to see?
Well, what I tackle, I mean, I love Lavo, and I think I've already put my name down to get one for my farm. So, but I'm a real believer in hydrogen being a game changer on storage and the whole renewable market. So, just looking at the residential unit, the shortfall of batteries with the short life of 1.5 hours compared to sort of the hydrogen of 8.5 hours. That is a game changer, and obviously applying that at a larger scale and safe will take just putting my cold hard finance hat on, taking a single digit IRR to trebling it by optimizing your price that you can sell your electricity because you've got storage, will make this broadly attractive. So, at the moment, I've seen there's some questions on ESG. There's a lot of the families that have foundations, they do believe in renewables and ESG. I think for large scale investment by the families in these areas, they don't know a lot. They want to see it proven, and they'll probably back early stage, but small checks. And then as you can demonstrate, the storage and what that can do, you'll get a lot more capital coming from them. So this shark's in.
Yeah, thank you. And then Stephen, over to you from an investor. I guess this is how, sometimes it flows. It does the early stage, starting up with, a wonderful collaborative partner like UNSW. You can get some grants, then you get some private equity, and then it moves into the either whether it's the bond market or institutional investment lending. Probably a bit early for large banks at the moment, but what would you then want to see as it progresses?
Yes, I think that's right. I mean, first of all, I would share James's view. It's a very exciting concept, and perhaps from our perspective as well, we're even more excited in the sense of the potential to move it to utility scale, where we can see sort of real benefits from it. I think from a senior lender point of view, and I think you started to allude to it. There's a kind of lifetime of capital where a startup will start with family money, maybe from or private equity, venture capital. It may then move into second and third rounds of fundraising, and then probably only after that it comes to the senior debt market. That is, unless there isn't a shareholder or a partner who can provide a guarantee for that debt, which is another way of moving more quickly. So senior debt would usually come in at a slightly later stage where you're looking to scale up an existing operation. So I think what senior lenders will tend to be looking for is a proof of concept. I think Amy talked about safety, certainly reliability, certainly. I think the other area we'd be interested in is looking at the market side of it. It's a tremendous concept, but clearly, there's competition from more conventional batteries for the same sort of service. Can you provide something that is more competitive at a lower price, or better service at a lower price? And I understand the answer is yes, but I think that's something that needs to be sort of proved in a proof of commerciality as well. Lastly, I'd say I think I tend to come from a project finance background, so looking generally at a company or a project that is maybe relatively a startup, but has very little financial strength of its own accord without support from its shareholders. And what we tend to do then is basically to look to another party to provide some of that strength. And one area that this might move is if there is a contract for offtake. If the company is able to get a contract from maybe a big housing developer or a municipality to take a significant number of units at an agreed price, that's the sort of thing that moves you more clearly into bankable territory, with all the benefits that brings of significantly lower return requirements and no dilution. Yeah.
And I think that's what we're aiming to achieve with Lavo. So thank you, Stephen. I want to put it out to the whole webinar of, is it a thumbs up, a thumbs down, or is it a wait and see, just to see what you think of this. Now, one of the big things that we're reliant on, I think, and it answers quite a few of the questions that we've come here, is around that demand side, that early adoption, the post-COVID-19, huge challenges, but huge opportunities. And I think some of the traditional industries, or previously attractive industries from hotels and travels and other elements, they're going to struggle in the future. Whereas when often recession elements happened, yes, well, that's good. First of all, acknowledging the nice results, we've got 77% yes. So I think both our shareholders and University of New South Wales will be happy with that result. But do you think, as people come off those other industries, you go into recession-proof industries, and energy consumption is definitely one of those. With that in mind, James, have you seen, a skew away from some of the investment that will open up additional opportunities in the energy sector, and also with the ESG markets? Because as we talk about, I think there's a great question there about low ESG risk and how that's being priced in at the moment for markets.
Okay, so ESG has been a very popular thematic for institutional investors for many years, the big supers. The families weren't that embracing of it, but what's happened is the next generation are taking over, they are passionate about impactful investment. So I've got a lot of money, I want to make an impact. They're putting their money where their mouth is. So I see just impact generally across the wealthy families is quite significant. If you look at, I talked earlier about a wealthy family will have a core. So let's say I'm Scott Farquhar and I've got my core investment at Atlassian. I'm made a lot of money. They take their dividends. Those guys have got about 100 million a year in divs they've got to invest. But impactful investment is a key message within their family offices. And you look at, Scott and his partner, Michael, and they are certainly, you see them almost every second day. They want to take leader positions. They've got the money, and they also want to marshal other families. And you look at Twiggy and others, of what they're trying to do by bringing other wealthy people together and make a real difference.
Thanks, James. Yeah. And I think you've definitely seen that through some of them who also have their philanthropic arms as well. And interesting enough with that one, I'm going to go back to a question that was earlier on there, is that sometimes that philanthropic arm could be a way for startup, for definitely environmental and social causes as well. And it was a question from Johnny, which was listening to Amy, said there's a white paper on the leakage of startup funding pipeline, which is too focused on technology and not on environmental. And Amy, from your perspective, have you seen a lot more going into the tech space, or is now, this is a clean tech innovation? So we're a nice hybrid between renewable technology, energy production, but also software as well. How do the triumvirate of those pulling all together, do you see it being skewed one way or the other?
Yeah, I think, technology was certainly the focus of the last decade. There's perhaps the software side of things, but now we are moving to what I would call physical engineering issues. Certainly in the energy market, there's some wicked problems that are associated with the physical nature of electricity. So that is going to require things like smart meters, control at the demand side, clever inverters, things that help system security, which is a physical nature of keeping the inertia, keeping the grid stable, keeping the oscillations in control, the voltage, etc. But I guess on a more general level, what I find fascinating at the moment, particularly post-COVID, is people really get the link between our environment, our economy, and what I call humans. That everything's much more tangible than it's been for a long time. We've seen the impact that a virus can have on the global economy, and I don't think people kind of realize how vulnerable we are, and that will drive investment from governments and the financial sector going forward, and high net worth individuals and the likes that James deals with through the Table Club. I think people are looking for tangible solutions that tick all those boxes, whilst in the past we may have been able just to focus on a niche IT software solution. So perhaps I hope that answers the question. We're having to really open our minds a lot more than we may have had to have done.
And I think that's our feeling from a Providence asset group as well, as we're looking at multiple investments at the moment. We're still in the generation phase because you still need that power to be commenced with, but then how do we use it and go through that full life stage, or the value chain of energy is going to be really important. And there's definitely technologies that we're investing in. There is the batteries, but then there's good old infrastructure as well. And I think one of the questions down there is finding out about appetites and view on renewable technology for agriculture. And I think James would know this, and Stephen as well, is a lot of big ag companies or private funds are definitely, they want to improve their sustainability. So there used to be a bit of a fight between farmers and environmentalists, but now it's kind of the bread and butter of where they belong. So I really think there is a strong appetite for agriculture to improve its environmental status, but it's also got a great return on investment because we've got to feed 7 billion people in the world. Have you seen any of those things, James or Stephen, in your time?
Well, yeah, I'm happy to kick that one off. So, you know, Australia and New Zealand are the food basin for Asia. Agtech has been a really growing subsector within startup capital and venture capital. And just looking at the family Calbetza that own Twine and lots of properties, Marcus Calbet has got Tankstream incubators, but 25% of his latest fund, which is 100 mil, is towards Agtech. If you look at some people may, the Grosvenor family in the UK, the Duke of Westminster, they have an enormous Agtech group called Wheatsheaf, and they've backed a couple of Australian businesses. We're seeing a lot of interest in this Agtech area for sort of food, efficiency, improvement, and it fits in with a lot of the thematics that the families have.
Stephen, did you have any additional comments on that?
Yes, I can only make really fairly general comments because I'm not a specialist at all in agriculture. But coming from my bank's perspective, initially I think the focus was very much on the energy transition following the Paris Climate Accord, and we committed 120 billion euros to raising capital in that direction. But our mission has clearly broadened quite significantly into sort of ESG, sustainability, positive impact finance, which would very much capture the agricultural issues that you're talking about. And some of that does gain support from the central bank to help us. But I was interested that when the bank made the announcement, our chief executive was launching our most recent sort of sustainable investment finance program. It did receive a very positive response from the market. So I think it's definitely a direction that we want and our shareholders want us to move in.
Yeah, thanks.
And Matthew, I might also just say, I might just jump in there. We're seeing some really interesting developments with the solar space. Traditionally, solar was built and consideration wasn't given to how it could coexist with agriculture, but I'm seeing a lot of need and opportunity where the farmers are saying, no, we can continue to graze, we can put the carbon back into the soil by growing low plants. The co-benefits are amazing, as well as keeping the sheep underneath them. You then got that diversification like an ecosystem, and the investors are prepared to pay more for when the farmers are continuing their multiple livelihoods.
Yeah. And I think I'm going to also hand over to Warwick before we probably need to wrap up as well, is because the University of New South Wales, there actually has been another CRCP grant, which is the Commonwealth Research one, that both Providence and New South Wales are involved in. And I'll let Warwick discuss this one.
Yeah, thanks, Matt. So this one's one of the older form, bigger cooperative research centres, CRC. So upwards of 35 million investment from the Commonwealth over 10 years. Plus 50 or 60 industry partners, and it is all about future food systems. And Providence are involved in that in terms of turning food waste into bioreactors and other forms of energy. So if anyone's interested, we'd be happy to chat to you about getting involved in that one. It literally just kicked off towards the back end of last year.
Excellent, thank you, Warwick. Now, I think it's time to come to a close. Now, we haven't got to everyone's questions here, but please, I know that the video is going to be shared and you'll probably have each of our details as well that you can connect with us all directly. There's been some great questions about hydrogen storage on there. Unfortunately, I'm not the scientist behind this. I'm more the investment side, so I was unable to answer your specific questions on this. But I know that the team here have got all ends of nearly that investment pipeline covered, from the early startup to late stage project finance, etc. So I hope you've enjoyed today, and I would really want to thank Amy, James, Stephen and Warwick for participating in today, and thank you all very much. And over to you, Tiffany.
Thanks, Matthew. That was a really great conversation, and as we can see by all of the questions that we received and the answers to the live polls. Everyone's really interested in what you all had to say. So thank you to our panel, Matthew, Amy, Stephen, Warwick and James. We really appreciate you sharing your insights with us today, and to our audience for all the questions. Just quickly wanted to add, our next webinar will take place on the 16th of July, and we'll discuss a recurring theme which is being raised in all of the conversations that we've been having to date, and that's on how we can make Cleantech's voice heard and how clustering can assist in creating a strong and resilient industry. This session will bring together our first international speaker, Bianca Dragomir, who is a European innovation cluster expert, along with local cluster managers and leaders. So thank you once again to everyone for watching Cleantech Conversations.